Welcome to the Investing Podcast presented by Tusk Media. This is Outsider Trading, an audio and video deep dive into the people, places, and things that we find most interesting in the market.
Hey everybody, welcome back to the Investing Podcast presented as always by Tusk Media. Real quick, give us a follow on Twitter, Facebook, YouTube, all that stuff. We are at Tusk Media LLC. Special presentation on YouTube this week. We have our first ever quarterly macro webinar. So Ben and myself kind of went through some of the things we're looking at within the economy, both domestically and abroad. So check that out. Kind of a good little snapshot. Most of our analysis is kind of on an individual stock basis, so I think it's a nice little deviation from our normal content. So again, that's on youtube.com/Tusk Media LLC. I'm Andrew Hall. Joining me, as almost always, Ben Nye. Ben, how are you?
I'm doing well. Busy week.
Really busy week. Thought it'd be kind of low key. We're writing a book, and I thought I'd write a lot more than I've written so far. So gonna have a big weekend. Writing a lot of pages. But today we're going to talk about American Express, ticker AXP. Full disclosure, we do own AXP. So for those who are going to go ahead and say, you're talking your book, yes, we are. We talk about the companies that we know and that we own. That's kind of what we like to do. That's why we own them, because we know them. Ben, overview on American Express earnings. What were kind of the big headline numbers that we saw?
Yeah, big headline was the EPS came in better than expected. Tax rate had a little bit to do with that, a little lower than expected on that side. But revenue also beat pretty nicely. Revenue came in at $8.3 billion. Street was looking for $8.21. So that's good result for American Express. The problem that I think a lot of people have seen from American Express is every quarter they seem to do pretty well so far this year. Q1 they did well, Q2 they did well, and you expect them to raise guidance because in Q4 the thinking was that their EPS guidance for the year, 560 to 580, was relatively conservative. Mm-hmm. They haven't come out and raised guidance yet this year, and they didn't do so this quarter either. There are a few reasons for that. We'll get to that in a little bit. But again, big headlines, cost reduction plan. They're trying to get $1 billion of cost out of the business. That's on track, maybe even actually better than expected. Revenue doing better than expected, obviously, by this time on a year-to-date basis than what they thought. Credit quality remains well within the bounds, and they're actually increasing the loans, even though the credit quality still is in bounds. And going forward from now, they will not be adjusting the Costco results. Because what happened is when they lost the Costco business, that really threw their business into a tailspin. And they said, okay, well, let's just sideline that and show what the run rate for the business is actually going to be. We still have to deliver earnings on the overall business, but we also want to say, our revenue isn't going to decline 5% a quarter or 10% a quarter or whatever it was declining. Instead, look at the underlying growth. Now that we've kind of anniversaried that, going forward, everyone, management, analysts, buy side, they're all going to have a better picture of what this company is actually doing and what it's capable of.
Yeah, it's kind of an interesting story, I think, from some investors that have followed this really since the Costco news, obviously before. It wasn't the first time we heard of American Express when they lost the Costco business. But what's interesting is you kind of have almost a misalignment from what you might expect in some regards. And what I mean by that is I think they've managed through that quite well, maybe better even than a lot of people have expected. Obviously, it's such a black eye on the business, and the way it was perceived was kind of, hey, this could be something that just continues to perpetuate. This business could continue to decline. But they've managed pretty well. They've executed really well. As I said kind of in the pre-production meeting before this podcast, typically I'm a little bit wary of major announced cost reductions. That tends to be, a lot of times I view that as almost a move of desperation. Kind of one of those things, it's almost one of those schools of thoughts, well, if you could have saved money, why haven't you always done that? It almost looks like the next step when you're trying to really save face and things like that for investors. But the fact that they're saying, hey, not only are we going to hit that $1 billion mark, we're actually going to go further than that, I think is a little bit of a testament to that execution. So you kind of look at this company and say, well, yeah, they lost the Costco deal, but ever since then they've really executed pretty well. They've had a good plan. They've followed through on that plan, and yet we're still not really getting guidance. That's kind of a unique juxtaposition because you tend to think of the companies that offer guidance, they know where they're going, they know what to expect, they're confident in that. But it seems like we've seen good execution, but still kind of not a whole lot of read through on what they're actually seeing.
Right, and I would agree with that. What I like to see is the company that says what that does what they set out and say they're going to do. And you can take issue with them not raising guidance, but I mean they're doing what they said they were going to do, and I think that they're being sufficiently conservative now. So what happened is, coming back to our discussion from earlier, they ended up, because of the good revenue performance year to date, they have raised revenue guidance beyond the 5 to 6% underlying growth range which they expected at the beginning of the year. That's positive. The tax rate is lower than they expected, and that's not really tax manipulation. That is simply they're getting international business is stronger than they expected. So international has a lower tax rate. Overall company tax rate comes down. Just as a quick side note, we do have some videos on Citigroup and JP Morgan, and they also were talking about how international business was strong. And you can see that in currencies and how the economic data has come in, especially in places like Europe. And they also say they're making great progress on the cost reduction initiative. So between cost, revenue, and tax rate, you'd say, well, that's a formula for higher EPS. Didn't get that,
And they're just kind of
they're pumping the brakes on that. I think it's going to come. I'll go out on a limb and say I think they will earn more than $5.80 a share this year. If I had to put a number, I'd say $5.85. I'm not putting a number, but if I had to, that's what I'd say.
Ben's issuing guidance.
And then I think when they can kind of get through this year, then you start to look ahead at 2018. Street is at $6.35 for 2018, and it's an $85 stock. So I mean, you can do the math on that, but the PE has ranged between 13 and 18 for the last 5 years. So I think even after the run it's had, I think it's an interesting entry point.
Yeah, and I think that's kind of the temptation. If you don't follow the stock closely and you don't have some of that historical perspective, it's easy to say, well, this sold off because of Costco. Now they rallied back. Is there really that much that's happening? But when you see just kind of what we're expecting on the earnings, again, as you said, probably maybe a little bit higher, at least we're hoping, a little bit higher than what was initially issued. And then you look at where the stock's projected to be in the next year, all of a sudden, it doesn't seem like it's really run that far relative to that. We're going to continue to hold it. Continue to keep an eye on it. What are kind of the major things you're looking for over the next couple quarters?
I'm looking for, I want that guidance range next quarter. I mean, I think by the time you get into October and there's 2 months left in the year, I mean,
get that.
Yeah, I mean, unless something really dramatically changes to the negative side, I think that's what you're going to see, and I expect that. I think the street probably expects that as well after this quarter. So it might not be a huge positive at that point in time. But over time, I expect that you'll see they really rebased expectations. They're a disciplined team. They've demonstrated discipline on the credit side, and they demonstrated discipline when they actually walked away from Costco. And you can bemoan how they left the Costco relationship for Citi to just snap up. All you want, you can complain about that, but the fact of the matter is, they had their return on equity targets. They had their expectations of what they expected from the business, and they didn't want to compromise that for Costco. And they had to give up a lot more in this Costco renegotiation than they did before. Costco's a lot bigger now than they are before. So I give management a lot of credit there. I give them a lot of credit for passing the CCAR, which is what the Federal Reserve does every year with banks and the systemically important financial institutions. So they're ticking the boxes, and I expect that to continue. And once you kind of get away from this messiness with the Costco adjustments, I think that the story will become a little more clear and result in a higher valuation for the stock.
Yeah, and one thing I think that may kind of have been an underrated, I wouldn't say catalyst because it's not that it's drawn the business upwards, but in some regards, you've had all this pressure from Chase and Chase Sapphire and all of this kind of on the higher end credit card type market. In some regards, Costco might not have been, the timing of that was somewhat fortuitous because I do think that kind of dominated some of the headlines. And again, is it a great thing when you have a negative headline? No, but at the same time, I mean, I still think there could have been a negative narrative out there in terms of competition they're getting from Chase. and all that. And I think they've been able to kind of fend that off as well. And I think you're starting to see that, in terms of, in the numbers, you can find a number of articles that would point you in a direction that says, no, this is under pressure because of competition, specifically, from Sapphire and all those programs. But I think we're seeing solid performance that would indicate maybe it's not quite as big of a threat as we might perceive.
And the brand is durable.
Yeah.
Brand is durable.
Yeah. Ben, any other closing thoughts on American Express?
That's all I have today. We'll be back next quarter for another update. And do check out our macro webinars, 45 slides, an hour of listening to Andrew and myself, so you may have to break it up.
Yeah.
And we'll be also sure to post the slides probably separately for people who want that as well.
Yeah, we'll get that up. Y'all have a great day. Check us out on Twitter, Facebook, YouTube, all that stuff at Tusk Media LLC. We will talk to you soon.
Tusk Media is a subsidiary of Narwhal Capital Management. Ratings and reviews of Tusk Media content are not to be construed as endorsements of opinions, analysis, or services offered by Tusk or its parent company. The opinions and predictions shared here are professional beliefs at the time of publication. We are not under duress from any of the corporate entities mentioned. This is not a solicitation to take any particular action. Although we are investment advisors, this information should not be considered investment, legal, or tax advice. We strive to be as impartial, insightful, and accurate as possible. We base our opinions, analysis, and calculations on information we believe to be reliable, but we cannot guarantee its accuracy. We can, however, guarantee that our opinions will sometimes be flat out wrong due to a variety of factors. Employees and clients of Narwhal Capital Management may or may not hold positions in the securities detailed and may or may not hold these positions in the future. A full list of all securities purchased, sold, or held during the 12 months preceding the date of this publication can be provided upon request. Unless otherwise noted, all data accessed via MarketWatch or the Bloomberg terminal. Past performance does not guarantee future results. A copy of Narwhal's Form ADV is available at the SEC's website, www.advisorinfo.sec.gov, or from Narwhal upon written request.